Equity markets are buzzing once again. This week, we've seen a lot more volatility. We did see a decline earlier on in the week as well. The surging number of coronavirus cases, which we're seeing in the US, but also in other parts of the world as well. Brazil now seems to be the center point as far as Latin America is concerned. And we're seeing some very concerning numbers coming from there. Obviously, we saw in Germany as well. We saw numbers starting to spike as well. This comes after we saw Beijing over the last couple of weeks see a spike as well. Now, Beijing has claimed to have got this under control quite quickly. So hopefully there's lessons to be learned there for other countries. Germany, of course, was lauded over the last couple of months of its handling of the coronavirus outbreak. So hopefully we'll see a similar situation there and other countries can learn the lessons. The main concern really seems to be in the US, where we're seeing reopening efforts, which in many cases were strongly supported. But now we're seeing the likes of Texas and Florida, California, where we are seeing these outbreaks again, the numbers of cases spiking. Now, that is going to be partially linked to the amount of testing that we're seeing. But the numbers that you can't really dispute on that front is going to be the rising death count that we see there. So hopefully, again, these situations can get under control. Lockdown measures will not be necessary, especially to the severity that we've seen over the course of the last few months, and that will enable stock markets to recover. But this continues to be and will continue to be a major risk for these equity markets. What these equity markets do have going for them, though, is this incredible amount of stimulus, and that's why that's what makes these markets so interesting, and that's what continues to support them despite whatever bad news comes out, whatever we see. The enormous stimulus continues to support these markets, and that's why it's difficult to really be too bearish at any given point, despite the cutbacks that we do see. What is interesting is that right now you look at something like the FTSE 100, currently trading around 62.50 mark, and it is starting to look a little vulnerable. Now, there's some very defined, clear key levels here, so this makes it an easy one to really monitor. You got 6,000 below. Major psychological level, provided significant support for the index on a couple of occasions at least. At this point to the upside, we've got 6,500. Again, nice big round number, historically a major area of support and resistance as well, as we've highlighted in previous videos, and again where we reached the peak during the most recent rally, not the most recent rally, sorry, the peak of this overall rally since the March lows. Now we've got 63.50, which I think is a real level of interest. So we're trading around 62.50 at this moment in time. 63.50, there or thereabouts, is where we started to peak on the most recent rally that we saw. So we fell short of the 6,500 mark before we came back and almost tested the 6,000 area again. What makes 63.50 now all the more interesting is going to be a case of momentum. If we fail to break 63.50 on this rally, which has already bounced strongly off that 6,000 mark, then that would be the second consecutive lower high that we've seen. That suggests vulnerability. Now, that 6,000 level, you'd have, as a result, this descending triangle pattern starting to form, and 6,000 would suddenly start to look very vulnerable. Unfortunately, that does create a big internal dispute for myself, for one, but I'm sure for many as well, in that these markets are so supported by stimulus that the prospect of a break below 6,000 does seem less likely than a hold above 6,000. But that is what the charts may be starting to tell us is looking possible. So certainly want to keep an eye out for, like I say, 6,000 the big level to the bottom, 6,500 the big level to the upside, but 63.50 could be a really key marker as far as these markets are concerned. And if we did see a break below 6,000, what makes this important is not only would that be a key psychological level breaking, but the size of the pattern from the 6,000 to the 6,500 marker, not always clear cut, not always straightforward, but would suggest that we are eyeing a pretty significant downside. Now, we may have to wait for a big trigger in that, and that may be lockdown measures starting to be enforced, or coronavirus case numbers starting to escalate to the point that it looks inevitable. But there are clearly concerns showing in these markets at this moment in time, and it's being displayed on the charts by these lower peaks, and another peak below 63.50 will just further reinforce this.